Hello everyone. In the last video, we discussed the system of indirect taxation prevalent before the 1st of July. If you haven't seen it yet, click on the link at the top of this video. In this video, we will see what changes does the GST system brings to the table. So let's start. So what is GST? GST has been defined as any tax on supply of goods and services other than alcohol for human consumption. Some of the properties of the GST system are: it has a one nation, one tax structure. This means it will subsume many indirect taxes like VAT, CST, excise, service tax, etc. Secondly, it is proposed to be levied at all stages right from manufacturing to the final consumption. It has a VAT-like structure. This means that taxes paid at previous stage will be available as a set-off at the subsequent stage. Keeping these properties in mind, let's look at the structure. GST is going to have three components: central, state, and integrated GST. Under CGST, present central taxes of central excise duty, central sales tax, service tax, additional excise duties, etc. will be subsumed. Please keep in mind that the revenue collected under the CGST is for the center. Similarly, under the SGST, the indirect taxes at the state level will be subsumed. These include VAT, luxury tax, entertainment tax, taxes on lottery, etc. The revenue collected under SGST is for the state government. Finally, IGST is charged on the movement of goods and services across the states. For example, if goods move from Tamil Nadu to Kerala, IGST will be levied. The revenue collected from IGST is shared by the state government and the central government as per the rates fixed by the authorities. Now, in order to ensure smooth operation, the base of goods and services to be taxed, as well as other essential design features of the GST, would have to be common between the center and the states. The tax would be levied on the basis of destination principle. This means in the case of interstate transaction, the tax would be levied in the state of destination rather than the state where the goods originate from. Extending this principle, exports would be zero rated as the sale is not made in India. They will be subjected to customs duty. Please note, customs duty is not part of GST. Imports would attract tax in the same manner as domestic goods and services. They will be subjected to a basic customs duty and IGST. Before we take up an illustration, let us look at various aspects of GST and its administration. GST will be administered by the GST Council. It will be the apex policy-making body consisting of central and state ministers in charge of finance. The Council will make recommendations on model GST laws, the rates, place of supply rules, and any other matter relating to GST. The centre will levy IGST on interstate supply of goods and services. States will have the right to levy GST on intra-state transactions only. Petroleum and petroleum products, that is crude, high-speed diesel, motor spirit, aviation turbine fuel, natural gas, shall be subjected to GST from the date to be notified by the GST Council. It has also been decided that the area extending up to 12 nautical miles will be under the central administration. However, states can collect tax on economic activities which are carried therein. GST may also be levied on sale of newspapers and advertisements. Stamp duties, on the other hand, which are levied on legal agreements by the state, will continue to be levied separately. So what are the expected benefits of GST? The main benefit that is expected is that it will be a simple and efficient taxation system. This should encourage tax compliance. Besides, GST will also help in creating a wider tax base. A wider tax base is necessary for lowering of tax rates. Moreover, elimination of multiple taxes and their cascading effects will lead to a reduction in price, provided the tax rates do not increase. Most importantly, harmonization of center and state tax administration would reduce duplication of efforts and cut red tape. Additionally, the new automated system of GSTN, that is Goods and Services Tax Network, would reduce errors and ease up the return filing procedure. On the other hand, there are a number of challenges as well. The most important one is the multiple slabs of GST rates. In the current model, there are 4 rates of 5, 12, 18 and 28%. Besides, there are a number of items such as raw agricultural produce, which is zero rated, and some luxury goods and those with negative externalities, which will attract a cess over and above the highest slab of 28%. This has made the system highly complicated. A silent drawback of this system is that of lobbying. Many producers or service providers, especially in the food processing sector, would want their products to be zero rated or so. This may give rise to unscrupulous classification in order to escape taxation. One more drawback of the earlier system, which the GST does not address adequately, is the number of compliance forms to be submitted to the authorities. Certainly, the compliance and registration for firms operating in multiple states has become easier, but not to the extent expected. For example, a firm operating in say 20 states will have to submit like 400 odd documents, although most of them would be automated. Hence, there is a huge scope of improvement here. There is one more concept which needs to be clarified before we take up the illustration. It is the concept of revenue neutral rate. RNR is the tax rate that allows the government to receive the same amount of revenue despite the change in tax laws. Currently, the total incidence of indirect tax in most of the states is about 30%, which includes 12% excise, 14% VAT and other taxes, depending upon the good. Under the GST regime, if the average incidence of taxation comes out to be, say, 20%, the government will lose out on revenue. Therefore, the effort has to be made to make sure that the tax rates are such that the revenue of the government does not decrease. The average GST rate, which ensures this, is called revenue neutral rate. It is the rate at which revenue will remain the same despite allowing input credits, exemptions, etc. Now, calculating of RNR is not same as simply adding the current state and central taxes together. For example, having a combined tax of say 32%, 12% center, 20% state, would be considered as too high. As such, there would be less incentive for people to comply at such a high rate. Therefore, RNR should be such that inspires compliance as well. It should thus take into account the expected benefits such as widening of tax base in its calculation. Now, at last, let us compare the GST system with the existing system through the same illustration which we took in the previous video. The bat was sold from UP to a wholesaler in Maharashtra, say Nagpur, who sold it to the showroom in Mumbai for selling it to the final consumer. Assume the rate of bat to be 100 rupees, with each party in the transaction wanting to earn a profit of 100 rupees. Further, assume CGST and SGST of 5% each and IGST of 10%. First, the manufacturer sells it to the wholesaler for rupees 200 plus taxes. Since it is an interstate sale, IGST at the rate of 10% will be levied. Hence, the cost for the wholesaler is 220 rupees. Next, the retailer in Mumbai purchases the bat for rupees 320 plus taxes. Tax in this case will be 5% CGST and 5% SGST, that is rupees 32. Now this rupees 32 will be offset against the tax which has already been paid, that is 20 rupees. Therefore, the tax paid is rupees 32 minus 20 equals 12 rupees. Thus, the retailer purchases it for rupees 320 plus 12 is equals to 332 rupees. Finally, the consumer will pay rupees 432 plus taxes. Again, 5% SGST and 5% CGST will be levied and offset by the tax already paid. Hence, the tax incidence is rupees 43.2 minus 20 minus 12, that is rupees 11. Hence, the final cost to the consumer is rupees 432 plus 11 equals to 443 rupees. As can be clearly seen, the bat which cost rupees 477 in the previous regime will cost only rupees 443 in the current regime, assuming that the tax rates remain the same. This is possible only because of the offsetting mechanism. We hope that with this illustration, your conceptual understanding of the GST is clearer. If you have any doubts, do let us know in the comments and we will try to address them.